So today we've got Clint Abraham from Morningstar to do a presentation for us. He's going to be going through insights into valuation implied returns and also provide a recent trade update and outlook. If you've got any questions, please feel free to drop them in the question box and we will address those at the end. I'll just hand over to you, Clint.
Thank you and good morning, everyone. Thank you for the opportunity to present to you today. We will talk a bit about markets and how Morningstar portfolios are positioned, but I must stress, please don't take anything I say as personal advice to do or not do anything. Obviously, the Future Gen team are much better equipped to understand your personal circumstances and to apply some of the things that we're talking about today to you. So feel free to reach out to the team if you have any questions around the presentation. And obviously, in the context of today, we will have the opportunity for you guys to ask any questions of me. And I look forward to taking those questions as they come through. So we might move on to just a bit of a slide that gives us a bit of an indication around how markets have done over the course of 2019. So I might actually go forward one more slide if I can. Again, there we are. And so what we can see on this slide is a range of asset classes and their performance over the course of 2019. So when we're talking about asset classes, we're looking at things like Australian shares, international shares, as you can see, listed property markets, both here and abroad, and bond markets. And so for those that haven't had much to do with bonds in the past, think of them a bit like a term deposit, except that the value of that principal amount, that amount invested will change as interest rate expectations change. So governments and companies, they issue bonds as part of their ongoing financing activities. So we could get a bond issued by the Australian government, perhaps some of the big banks, for example, and we can use those as part of our investment available investment universe that we can fill our portfolios with. So what I wanted to show, I'll just get you to go back one slide if that's okay, is the return from these major asset classes over 2019. And as you can see there, they've really broken out into two groups. And the top half I'm going to categorize as growth assets, and the bottom two there I'm going to say are defensive assets. And you can see that there's a clear difference in the way those assets have performed over time, over 2019. And if you look at it, you think, okay, well, bonds have underperformed equities. And so, that's not uncommon when there's very much a growth theme in markets. But when you actually have a look at how, the magnitude of those bond market returns, they're actually really quite significant. So if you cast your eye to the left-hand axis there, you can see that those bond markets have delivered almost double-digit returns over the course of 2019, and that is an extraordinary return. And really what's driving that return is the change in interest rate outlook that we've had over the course of 2019. So some of you may recall this time last year, we saw significant volatility in share and bond markets, and it had a lot to do with what was going on in terms of the market's perception on the direction for interest rates. And so what I mean by that is that this time last year, US bond yields, so the yield on a 10-year US government bond, it was increasing because a lot of the emergency support measures that have been in place since the global financial crisis were progressively being withdrawn by the US Federal Reserve, which is the equivalent of our Reserve Bank. So it's effectively saying that US economy is going along all right, the corporates are doing reasonably well, it no longer warrants having the same level of support from central banks. And so they were very good at signaling that interest rates were going to rise. And markets really reacted to that because at the same time as they were saying this, there were some concerns around global growth starting to come to the boil, and those two things going together doesn't end well. So what you saw was a lot of weakness in share markets over that final quarter of 2018. But around Christmas time, again, the Federal Reserve came out and said, actually, we're not going to raise rates to the extent that we thought we were. And in fact, as we look across 2019, the expectation for rates has fallen. And you would all know that it's this time, so this global thematic has been sort of going on for a little while, but really Australia's been heavily included over 2019. As you know, our own interest rates have been cut significantly And we have some slides on that a little bit later. So Australia is very much participating in this outlook for lower for longer interest rates. Now, why bonds have done so well is that bonds move in the opposite direction of interest rates, all things being equal. And so when you see significant interest rate cuts, bonds actually do very well in that environment, which is here. This is well above what we would consider a reasonable return from bond markets. And again, it's the defensive part of our portfolio. So we're not really looking for strong returns from that part of the portfolio. We want that part of the portfolio to help us balance some of the risk that we otherwise might encounter in share markets. So moving on to the other, I guess, grouping of assets that are there, we can see that it's actually been an extraordinary period for share markets too. So, and in many ways, they're responding to the same driver, which is this lower for longer interest rate outlook. So, investors who are possibly looking at Australian term deposits or cash generally or bond yields, now the return there is actually quite low, and people are starting to take more risk because they are trying to get a better return than what some of those defensive assets are offering. And so we can look there and we can see Australian listed property and also Australian equities have done very, very well. Again, that's very much a global thematic. So those global equivalents for listed property and for share markets have done very, very well. I guess the thing with listed property, which would raise some concern with us, is that when you look at those asset classes, they're kind of, while they sit as growth assets, they kind of exhibit elements of defensive assets as well. And so when you see here that they are delivering returns like share markets, it doesn't look quite right for us. And I'll share with you around how we see all of those asset classes on an outlook basis going forward a little bit later in the presentation. But suffice to say, it's been a really strong period for share market returns. And I'll share with you what that looks like for portfolio returns in a few slides' time. I'm moving forward to one slide, and you can see the magnitude of those interest rate moves. So this chart is looking at the interest rate, the yield, on a 10-year bond for both Australia and for the United States. And so you can see for the US, roughly around 3.2%, or certainly above 3% this time last year, and it fell to be about half of that in the middle of this year. It's rallied back a little bit, as you can see. And for Australia, again, well above sort of 2.5% this time last year. At the lows there between July and August, that was below 1%. So that is a very, very big move. That level of below 1% is unprecedented in Australia. More recently, you would have seen quite a bit of commentary around the outlook for the Australian economy, both in terms of the Morrison government looking to deliver an increasing, or certainly a brought forward infrastructure spend. More recently, again, as in literally the last couple of days, we had the RBA, the Reserve Bank governor, sharing his thoughts around, I guess, the outlook for interest rate policy in Australia and some of the measures that they may look to implement if the economy deteriorates and you find yourself in more crisis-like scenarios. So it's very hard to predict the outlook for interest rates, but suffice to say we're probably in a lower interest rate environment for the foreseeable future. There's potentially one, if not two more interest rate cuts. And again, this is the RBA's own measure that if they do in fact happen, then you may see some more unconventional responses from the Reserve Bank in terms of how they look to stimulate growth, etc., in the economy. When we have a look at the individual share markets, so again, this is taking that global share market return that we saw previously and dividing it out into the individual major regions that we look at. And again, you can see a clear divergence among a group of share markets that have done quite well and others that have done less well. And if I could broadly just divide the line down the middle there and say the ones that have rallied above that average point, it feels good to invest there. And the ones where it falls below that line, it doesn't feel as good to invest there. So I'll talk about that in a little bit more detail. So if you look at those share markets that have done well, The Australian market is key in there. The US market, obviously, we've spoken about both of those, how a more supportive approach from their central banks means that investors have a bit more confidence in those markets. The same extends to Europe. So the ECB have also reconfirmed their commitment to providing whatever support is needed in those economies. And so investors are, have taken that confidence and, they're using the lower rates to justify higher share prices in those markets. And it feels good there. So, we acknowledge that sentiment, but as I'll share with you a little bit later, the challenge for us is understanding, well, what the way that we would approach this is to understand what's in the price, and the challenge that we face is the price that we think these assets are worth is actually quite a bit less than what the current share prices for many of these are trading at. Now, the stuff below the line, it doesn't feel as good to invest there. So when we think about some of the key issues in the world, trade wars are very much front of mind. They've been ebbing and flowing at times quite significantly over the course of 2019. And you can see as Trump makes America great again, it's expected to benefit the US economy and US share market. But trade wars are a zero-sum game. In many ways, it's who loses the least that is going to, I guess, benefit. And so if the US is going to benefit from trade war negotiations and someone needs to lose, and it's perceived to be those emerging market economies like China, Korea, Taiwan, other exporting nations like Japan and Germany. So you can see there the German index, which is that sort of brownie coloured one, has remained under pressure for much of the year. And it's only very recently, if I was to extend this data set to capture the last couple of weeks, you would see that Japan has done quite well. But for much of 2019, it has lagged, given some of these and a few other issues. Emerging markets, again, as I touched on there, particularly countries like Korea, have lagged. And then, of course, the UK is very much in the throes of Brexit. It feels like it's getting to the pointy end, but we've perhaps been here before. It's really, really difficult to forecast how Brexit will play out, and there's certainly no shortage of news flow at the moment. It feels like very much a moving feast. So that poor sentiment is weighing on the I guess the outlook for the UK share market. I will come back to that later because there's potentially, or we think that there's a key opportunity in the UK share market at the moment. So the chart that I showed you on the previous slide was effectively a 9 or 10 month chart that captured returns over 2019. What this is doing is looking at a 12-month chart to September 30. So it really picks up the final 3 months of 2018 and obviously the strong first 9 months of 2019. And the timing of this is, I guess, deliberate, because I wanted to show that while it feels like it's been a very strong period, and it has in 2019, when you actually go a little bit longer, and to be honest, 12 months is not that long, but you can see that actually share market returns are a bit more muted than what you might expect. So as you might recall, Q4 last year was a really volatile period, significant weakness in share markets of between 10 and 15%, depending on which one of those, which major share market you're looking at. And then, as we've said, 2019 has been very strong. So when you add those two things together, you get what you see on the screen there. So there is a bit of green there. Potentially in some of those emerging markets, Australia stands out. A 13% return for that 12-month period is really quite strong. But actually, more broadly, some of those returns are much more muted. So the US is sort of 3.4%. Some of those emerging markets that I identified earlier, Japan, South Korea, Germany I touched on as a key exporting nation, those rolling 12-month returns are actually negative. So again, this is the trade wars having an impact on sentiment in those share markets. The UK, while positive, is also still quite muted. Again, Brexit's kind of weighing on the outlook for that market. And so generally, yes, it's positive, but when you have a look at that longer time period, it's perhaps not as rosy as what the last sort of 6 or 9 months would have you believe. And so what does all this mean for portfolio performance? So going to actually, I might get you to go to the next slide first, and then we might come back to this. So this is just simply looking at the portfolio, a growth portfolio versus the peer group. And so just to be clear, with our portfolios, we are not necessarily trying to beat the peer group. It's kind of nice if it happens, but that's not our objective. What we want to do is we want to deliver an outcome that's related to inflation, and we want to at least keep up with inflation because that's the purchasing power of your savings. We want to at least maintain that. So, as bread and milk go up in the future and you're pushing the shopping trolley down the aisle and all those things that go in there, as they go up over time, which is effectively what inflation is, it's that tendency for things to just get more expensive over time. We want to make sure that the dollars that you have and that you've saved are still going to buy, all your groceries in, with the same purchasing power as you have now. And then obviously we're looking to grow that as well, so as you can achieve some other goals as you approach your retirement or indeed enjoy your retirement. And the way that we want to do that is by not losing money that we may never make back. So that leads itself to, I guess, some interesting comparisons when you compare with others in the market. So what this chart is showing is returns and risk as defined by how much the portfolio has fallen at its worst point in that particular period versus everyone else that's a growth portfolio in the market, or the peer group that Morningstar measures. And so what you can see there is that, on a 1 and 5 year view, generally delivering peer-like returns, but across all 3 time frames, and certainly the longer time frame is the most important here because we are genuinely long-term investors, and for the most part, you guys are long-term investors as well. You can see that the portfolios just are not experiencing the same level of risk. They are not losing as much as peers in times of market uncertainty. So the way to evaluate this is not so much return without any regard for risk. What we want to deliver is the best return for a given level of risk. And pleasingly, the portfolios remain on track to do that. So what worked well, if we might go back a slide there, we can talk about, they are on track to achieve and maintain their longer term objectives. We have been able to introduce some new positions into the portfolio, which, given it's been a pretty strong period for markets, we're very pleased to be able to do that. There is some value there that we want to take advantage of. But we just need to be mindful when we're comparing to peer market returns. It has been a very positive sentiment-driven period for shares and bonds. And we are very happily holding more cash in this environment because the risk of losing money is quite significant. In fact, we are as different to everyone else as we have ever been. And so, we just need to be mindful that if markets keep running, we'll probably lag a little bit. We're all right with that. We've experienced this before where sentiment can push markets to levels that we don't think can be rationally justified. We just need to be patient long-term investors and wait for the opportunity to buy some unloved assets that will inadvertently get discarded when times become more uncertain, whenever that might be. The other point, I'll just go back to the following slide, if I could say it that way, is it's worth highlighting here with performance. So when we look at 12-month numbers, one of the reasons that we don't concentrate too much on them, it doesn't align with our investment process. We're not trying to deliver, 12-month numbers or beat someone else on such a short time frame. It doesn't actually add value to you guys as investors in the long run, in our view. But it's a very volatile data set. And so what I mean by that is, if you think about a 12-month return, really what you're looking at is the collation of 12 individual months of return. And so as time passes and another month passes by, you get a new data point because you've just completed a new month, and we're about to complete a new month now. And then what will roll out is the oldest data point. So we're about to complete returns for November 2019. 2018 will roll out. Now, joining a few things together that we've spoken about already, if we think about the 12-month returns to September 30, which is what this data here is showing us. That effectively captures the 9 months of 2019 and the last 3 months of 2018. Now, as we've spoken about, 2018, those final 3 months were very volatile and they weren't particularly good for investors. So we saw losses in that period, but 2019 has been very good. So now what will happen as we move to December 2019, the 3 months that were there from 2018 will roll out. So those 3 negative months will roll out of calculations and they'll be replaced by a new 3 months for October, November, December. Now, we know with reasonable certainty, let's assume that November's ended, October and November have been quite strong months. So you have negative months being replaced by strong months. So what's the point of all that? It is that unless we see some sort of a catastrophe in the final month of 2019, your 2019 returns are going to look very strong, really strong. So again, if you cast your mind back to those earlier slides where we saw share market returns, up around 20%, bond market returns around 10%, they're actually a little bit lower, but let's just use those rough numbers. It means that that's going to be the predominant driver of your 12-month return. So barring exceptional circumstances, you'll see double-digit returns for the average growth portfolio, which is exceptional. But I need to caution that it's not particularly sustainable at this point. We think we're probably, we're not forecasting some sort of a catastrophe, but we're probably coming into a lower returning environment, and it's just a function that we've had such a good time. We need to assume that we will see a period of more muted returns to make the whole thing fair. So I sort of go around the country and I do presentations like this a lot, and I was I was reminded by a farmer when I was in one of their communities that if you have a bumper harvest, you don't spend as if that harvest is what's going to be year on year on year. And obviously those people are struggling right now. So we need to prudently manage, we'll happily take these strong returns, but in our view, they are not reliable, reasonable, sustainable expectations for what we can expect in the future. And so what will happen is that, all things being equal, barring no, unforeseen circumstances, 2019 returns will be quite strong. And then as we move into 2020, a very strong Q1 2019 will fall out of calculations. And then depending on what, markets do in Q1 2020, that will, guide what 12-month returns will look like. So potentially you have a situation where you'll see 2019 12-month returns look very strong. And then as you go into 2020, they might actually come back a bit, purely because strong months then fall out of the calculation. So what's changed in the investment process? Absolutely nothing. Portfolios continue, we're mindful of these short-term spikes in 12-month numbers. They happen all the time. Again, we're focused on, the longer-term reward and risk numbers. I'd encourage you guys to do the same, because that's what's going to be most relevant for you achieving your goals in the long run. But just be mindful that you might see some volatility in those numbers depending on what the next few months of share market and bond market returns look like. Okay, let's take a look at some of the things that we think are interesting at the moment. And I guess this is one of the key points of difference. So, many in the market, if we look at this idea of risk, so some of you may have seen this chart before, and what we're looking at here is that horizontal sort of rosy coloured line. Let's assume that's fair value. That's what we think the asset is really worth. And then simply that red line, that sort of, that nice little sine wave, is how markets might move over time. Obviously, it's never that orderly in practice, but there'll be certainly times where you have the opportunity to sell that asset for more than it's worth, when it feels good to invest, when it feels like the good times are here to last, and then there'll be an opportunity to buy for less than it's worth, to potentially get that on sale. And that's what we're most interested in as valuation driven investors. And if you think about what that takes, invariably there's some sort of a headwind that is affecting sentiment towards that particular asset. Now, that could apply to both a stock level. We could think of, examples of this in the past where the portfolios invested in CBA and Telstra in times of market uncertainty. Arguably, Westpac is here at the moment where sentiment towards that particular stock is very negative, and understandably, the allegations are very, very serious. So we can understand why sentiment is negative. But what you'll find there is that invariably investors lose track of price and value. So, whether it's a stock, whether it's an asset class like emerging markets, like I touched on before, humans as investors don't like that uncertainty. They don't like anxiety. They're more likely to sell at any price to remove that emotional feeling. And again, if we can understand the value, if we can understand the quality of the cash flows that these assets are going to bring us, and we can understand and we can appreciate the behavioural biases, if I could say it that way, that are driving their investment decision, potentially that creates the opportunity for us to buy an investment, and which we think will deliver over the longer term. And so this idea of risk I touched on about before. Risk for us is the risk that we will lose money that we will never make back. But it might surprise you, but that's not how much of the market actually thinks about risk. You would have heard this term of volatility. How much does the portfolio bob around, if I could say it that way? And so, there's an important distinction here, because if we were to follow the path of that blue arrow, let's assume that there's a stock there and it falls significantly. That means that the individual holding is more volatile. There's a greater spread of returns around its performance now. And so if volatility is your measure of risk, then by definition, that stock, that holding, that asset class, whatever you're looking at, is now more volatile because it's fallen so much. So it might mean that you are not in a position to buy that asset now. It might mean that you can't buy as much as you otherwise might because it's perceived to be more risky. But we would challenge that and say, well, is it really more risky if your definition is losing money that you can never make back? And you can see on this chart here that, at that level, there's actually very little future downside. And in fact, if you're able to hold it through that period of negativity, and again, if you're buying quality assets where management have the levers to pull to navigate their difficult headwinds, then in fact, there's very little downside, and over the longer term, there's much more upside. The balance of probabilities, if I could say it that way, is in your favour if you are a longer term investor. And so this is quite often why you'll see us buying assets that have fallen, where some of the more modern finance theories would say they are now more risky. We would argue, well, they're risky at the top of the peak, but the fact that they've fallen so much means that actually the risk is in our favour. There's probably little downside, and then if you look past that, what you can see is actually a pretty strong valuation opportunity. And the reason that this is really important is around how you manage losses. So, if I'm honest, anyone can make money in a rising market. Most things go up. At times, the tide will lift all boats. But the way that you manage money in falling markets is really important. And you guys are probably familiar with this idea of compounding. It works very well from, a savings strategy and, helping to deliver your goals over time. But it actually works in reverse too. And so what I mean by that is if you had an asset or a sum of money and it fell 10%, you need to generate 11% off what's left to get you back to your starting point. But the thing is, it's not linear. So the more you lose, the more you need to gain. So again, you can see if you lost 30%, you need to make 42% off what's left. If I had $100 and I lost 50, I then need to make, I need that remaining 50 to double to get me back to that starting point. And that's not easy to do. So the learning here is don't lose as much. Then you don't need to take as much risk to get that money back. And that's, there's a lot of evidence around that. And I can happily take some questions on this. But really what we've seen, and we've done some analysis around this, if you don't lose as much money then you have a much better base from which to deliver future returns. And we're talking about risk as, risk of losing money that we will never make back, which is true. But let's think about risk from perhaps a perspective of your guys. While you'll certainly sympathise with that definition of risk, I think in a practical sense, what it means for you is you may not be able to retire when you want. You may have to take another, perhaps a part-time job to keep things ticking over, or you may have to curtail your retirement goals. You may not be able to take that holiday that you've been looking forward to, all because if you've been inadvertently exposed to the market when you're not being properly rewarded for being investors, and you've seen the size of your nest egg fall. So again, think back to a global financial crisis. The average growth portfolio was down 30 or 35%. So if you have a $500,000 balance, somehow, now you're down around 300, 350. That is a significant impact on your lifestyle, which is why we have this focus on let's try and not lose money that we can never make back. And then we've got a much better platform basis that we can deliver gains going forward. Just in the interest of time, this is some of the research that sits behind that. So I won't go into that for the moment. But suffice to say, if you manage your downside, you are much better off in the long run. But it does have an important implication. Actually, just go back to that slide a moment, because often, when we say that we don't want to participate in the downside, that's true, but it doesn't come for free. You need to give something up in that. And what we believe is the right way to approach this is that we need to accept that we may not participate in all of the upside either. And so what this analysis is showing is if you participated in 90% of the upside, but only saw 70% of the downside, are you better off? And that's what that green line represents on this chart. You definitely are. You cannot be fully invested to appreciate all of the good times and then not expect to be fully invested when the down times come along, because we just simply don't know when they're going to happen. And so often what you find is you find big swings in portfolio values when that happens. And that's something that we're generally not interested in, because we know that humans, us and you guys on the line, we know that we experience this thing called loss aversion, which means that we fear losses much more than we value gains. And the problem with that is that when we fear losses, we're much more tempted to do something. We don't know what, we just feel like we need to do something. And that usually is quite destructive. It means that we either play around with our portfolio, or we sell up at the worst possible time and go to cash, or something like that that really inhibits our ability to achieve our longer term goals. So ideally, if we don't fall as much, it's less likely to have an impact on investors. As you know, for those of us that follow our investment process, we're more likely buying unloved assets at that time that have been discarded. And that's what we think is really key in achieving those longer term returns. But it does mean that in the short term, no, that's okay, you can stay on that other slide. It does mean in the short term, month to month, it might look like we're underperforming, because if markets are rising and we're saying we're happily not going to participate in all of the upside, it might look like we're underperforming month to month, but it's only in the fullness of time that you can see how that portfolio approach benefits in the long run. Okay, so the other topic I've got here is around energy shares, and the reason I made the comment before, there's probably two key themes that have gone into the portfolio over the second half of 2018. Now, apologies for the font here. Morningstar have great font that can only be read on Morningstar computers, so apologies in advance that this looks a little bit messy, but I'm happy to talk you through it. So generally speaking, over the course of 2019, our mix of growth assets like shares and listed property and infrastructure versus defensive, which is predominantly cash and bonds, hasn't really changed. We're holding less growth assets than we otherwise might, because the risk of loss in some of these more traditional share markets is increasingly significant. So the overall mix of growth defensive hasn't changed. So a 70% growth portfolio, which is our growth, so that would be its long-term target. It's sitting just below 60% growth assets, about 58% growth assets. That generally hasn't changed over the course of 2019. But what has changed is where those mix of growth assets are coming from. So the key themes have been to hold less Australian shares than we have at the start of the year, partly because the whole asset class has done well. You might recall that if you've picked up the news overnight, Australian shares have now hit a record high. In past weeks, they have recouped, or they've made it back to that level that they were pre-GFC, pre the financial crisis of 2008, 2009. And so they've really done quite well. Now, in addition, a number of shares within our portfolio have done returns, many magnitudes of what the local market has done. So the individual share names have done very well. There's no longer the same level of appeal in some of those. And so we've generally been trimming Australian shares and in some cases exiting positions altogether. For listed property, again, you might recall from that first slide, I made a comment along the lines of Australian and global listed property has been delivering returns that actually look that are in line with share market returns, which is not what we would typically expect. Those returns are very, very strong. And so again, I'll share with you our outlook views in a moment, but suffice to say that those assets are not presenting as good a deal, and so we've been trimming those. And for both Australian shares and for listed property, the proceeds have been effectively rolled into opportunities that we can see in international share markets. So for those of you that have been following the portfolios for a little while, you'd know that we don't hold a large weighting to US shares. That's true, and our weightings there are very concentrated in individual sectors. And so that's things like consumer staples, healthcare, and I will touch on energy in just a moment. But where we have seen some opportunity is in some of those more unloved assets. So I touched on UK shares at the moment, earlier in the presentation. In August, we made a standalone investment in UK shares via an exchange traded fund that's issued by Beta Shares. And so what we can see in UK shares at the moment, when you actually have a look at the UK share market, what you see is a wide range of multinational companies. You would know many of the companies. In many cases, you'd be using their products day to day. So while Brexit is weighing on the UK economy and is a very big deal, even though we don't know how it's going to end, the UK economy is not the UK share market. So as I said, there's a number of multinationals, very high quality, cash generative businesses. It's really a who's who of global business. And at the moment, because they earn a lot of their revenue offshore, the fact that the British pound has slumped means that the value of those offshore earnings is much greater in British pounds. But at the moment, the whole thing is being weighed down by Brexit uncertainty. And we think we're getting a pretty good opportunity to buy into that particular share market. And so in August, we did do that. A growth portfolio off the top of my head has a direct allocation of about 4% to that share market at the moment. If you look at it, as I said, it's a who's who of global business. It's the likes of BP, Shell, HSBC Bank, Barclays Bank, and GlaxoSmithKline, which make Panadol, among other things. So it's a real who's who of global business. But the more recent trade position that has gone into the portfolio over the last really over the last month, is around global energy securities. So we can see here, just go back one slide. So we can see here over the course of 2019, for much of the left-hand side of where that vertical dotted line is, this is global shares versus global energy shares. So just carving out that sector of energy versus the broader market. And you can see there, generally speaking, it's tracked along okay, but really around sort of June, July, there started to be some significant divergence. And what we think is happening there is that investors, there are starting to come some increasing headwinds around the outlook for global growth, and we think that investors are not really taking seriously the current oil price. Or if I say that another way, they don't think that oil price can be sustained. And therefore, that's obviously going to be a key driver for some of these oil and gas companies. When we look over at a broader time frame, so the right-hand side is looking at 3-year annualized returns for the various sectors, and you can see that energy has really been left behind on that. The IT sector in particular is flying, and it's very much dominating media. But for us, energy's been left behind, and so the relative appeal of energy has improved. And from our point of view, it warrants an investment. It's worth again highlighting here that we are very much contrarian investors, so we think that we can find better opportunities by buying when others are selling and selling when they're buying. And again, we've talked a little bit about the behavioural impact. That means that when we're buying, it's typically unloved, and when we're selling, it's typically very much in favour. So if you look at something like the IT sector, very much in favour, dominating newspaper headlines. But we need to disassociate ourselves with, that 24-hour news cycle of trying to sell newspapers versus identifying opportunities that we can invest in that's going to deliver long-term investment returns for our clients. And so this is where, this theme around energy comes in. Again, I will get you to go to the next slide, please, and we can see some of the companies that make up this particular investment. So again, it's very much a who's who of global oil and gas names. Again, you'd certainly know all of those names. I suspect you'd use the products from a few of them, in any given week. So Exxon and Chevron in the US, again, Shell, Total, BP. And so you can see there in some ways, those companies are coming through on multiple filters. The UK share market is depressed, which is where BP and Shell have listings, even though it says Netherlands there. They have listings in the UK. So it's coming through on both an energy filter or screen, if I could say it that way, as well as from at a country level. So, happily invested in those particular companies, which we think are very high quality businesses, able to weather this environment pretty well, and we're getting well compensated to invest in them at this point. I think that's my last slide. Is it not? Oh no, I've got outlook slides in here. Excellent. Okay. So let's talk around where we see some opportunities in current share markets. So for those that haven't seen this chart before, what we're looking at here is expected returns after inflation for a range of growth assets like shares and listed property. And we're comparing that. So we've got September in the maroon and December 2018 there. Now, the timing of that is deliberate. That 9-month view captures, as we've said a couple of times here, we had a very weak run into Christmas last year, and that blue bar captures the improvement in expected returns. And so what we can see is that where the red bar is below the blue, which it is for everyone, expected returns have fallen. Why have they fallen? It's because the asset in question has run significantly, and returns are no longer being expected to the same extent because they're now getting captured in current share prices. So we're getting generally a poorer deal across the board. Again, if I was to draw a line down the middle, the stuff on the right-hand side feels good to invest in. And we've talked a little bit about some of those assets like Australia and the US. So effectively what we're saying, I'll just group Australia and the US together. We don't think that returns from this asset class will keep up with the pace of inflation on a 10-year view. So that's a pretty significant statement. The risk of loss there is quite extreme, actually. So you're getting a low expected return, a high risk of loss at a market level anyway. That's not a particularly attractive investment outlook. If I say that another way, if we look at share prices in those markets, and we kind of work backwards to work out what assumptions we need to make to justify those share prices. When we look at things like profit margins, for example, we need to assume that companies in those countries make profits that are, that they have a profit margin that is much higher than what we would reasonably expect, and they're able to sustain that higher profit margin for much longer than we think is reasonable. So, there is a possibility that happens, but I'd suggest to you it's quite small. And there's a whole other range of possibilities that say actually they can't deliver, and they certainly can't sustain high profit margins forever. If that's the case, then in theory, the risk of loss in those share markets is significant. And again, this is just a market comment. So if you're able to look at sectors or companies In each of those countries where you are getting a better deal, it does make sense to have some investment. And again, for those of you that know the portfolios, our Australian equities component looks very different from the Australian share market. This is why. There are, however, other markets where it makes sense to have the entire market. And we've talked a little bit about the UK. Sorry, go back a while. We've talked a little bit about the UK. You can see it there, second in from the left-hand side. These returns are much more what we would consider fair. You're getting a reasonable return. Brexit is weighing on the whole thing. We're happy investors to take the market exposure, the FTSE 100, which is what's in the portfolio. I have, if you look to your right there, I touched on Japan briefly. Again, we can see fair-like returns there. The impact of trade wars is weighing on that market and other issues. But if you actually have a look at, again, Japanese companies, high quality businesses, in many cases multinationals, and there's some really encouraging profitability trends that we want to be a part of there. So again, Japanese equities are very much in the portfolio. I won't spend too much time on the bond universe, which is the next slide, but to suffice to say, that's not a particularly good picture either. Many of the bond markets that we look at, are quite unattractive. So if you go forward to 2 slides, this is kind of a summary of where we see opportunities at the moment. It's a hopefully a pretty helpful matrix. You'll notice that there's nothing in the undervalued row. There's not much that's cheap out there at the moment. It's a pretty challenging environment, and it's really as a function that share prices and bond prices have run a long way. It presents some challenges for us as investment managers because it means that we need to look a bit harder to find value opportunities. We need to turn over a few more stones, if I could say it that way. And some of the opportunities that we see are not where the Australian investor might typically invest. We're okay with that. We're happy to invest wherever we're getting the appropriate return. And as you can see, there's some of those better opportunities, UK, Japanese shares, from the bond space, bonds issued by emerging market governments appeal relative to some of the developed world bonds that we otherwise might look at. And generally the key point to draw out there is that for some of these assets, the risk of loss is extreme. So, can we have that? Can those markets lose an extreme amount? Well, yes, they can. You only need to look back to the 10 or 11 years around the GFC, and you can see the types of losses that can be experienced in share markets. So again, we're not forecasting some sort of catastrophe, but we want to invest where we're getting rewarded appropriately, and it's away from some of those assets that offer us extreme risk of loss. So I might pause there. I guess that we touched on cash. It's not specifically on that slide, but when you're in that environment, you want to hold much more cash than you otherwise might. It helps to buffer the portfolio if you do see some volatility, and it also means that you've got cash in your wallet, so to speak, to go buy things when they come on sale in times of uncertainty. So that might come through.
Okay, so we haven't had any questions come through, but if you do have any, if you watch this back afterwards, if you could send them through, we're happy to address them then.
Yes, of course.
All right. Thank you so much for your time, Clint.
Thank you, everyone.